Having enough knowledge about finance and running a small business is crucial nowadays. In the first part of this 4-part series, we talked about starting a business. You had your company called Granny's Iced Tea Stand. You had your balance sheet, income statement, and growth projections. In the last part of the previous video, we stopped after projecting your business 5 years later. After computations, we predicted that after year 5, you will have 3 times what you've started. In this video, you'll know if what you started is a good or a bad business. Welcome back to Knowledge Pilot. Did you start a good business? What do you think about how good or bad it is? Well, one thing to think about is how much money you make compared to how much you put into the business. When you started, you thought this business was worth $1,500. Your investor paid $500 for 1/3 of the business. You said it was worth $1,500. By the end of the 5th year, it has made more than $1,500, which is more than a 100% return on the money you put into it. In fact, that's a pretty good number. Now, let's talk about the return on capital. You've spent $2,100 in capital building iced tea stands, and in the 5th year, you've made $2,336 on the money you spent. That's more than 100% return on capital. That's a very attractive return. Earnings have grown at a very fast rate, 155% per year. Your profitability has grown from 1.3% to 28.6% by year 5, which seems great. So let's look at the person who gave the loan. Well, they put up $250 and the business is profitable. You've been able to pay them their 10% interest or $25 a year, and they're happy because they put up $250. The loan gives them a 10% return, and the business is worth much more than $250. You have more cash than that. They're secure, but they only made 10% on their money. Compare that to the equity investor who acquired the business shares. In year 5, the guy earned $1 a share on an investment of $1 a share. So he made about 100% on his investment compared to 10% for the lender. So who got the better deal? Obviously, the equity investor. Why would an equity investor earn more than the lender? Simple, they risked more. If the business fails and you sell the iced tea stands for $250, the lender receives all their money back. They also earned 10% while the business was running, and they got their $250 back. Safe. But the equity investor who bought the shares was wiped out. This is because the lender gets the first position on the company's liquidated proceeds. There was nothing left to give the equity investor. Okay, let's talk about debt versus equity. What's the difference? Debt is safer since the lender has a senior claim on a company's assets, and it comes in many forms. There's senior debt, junior debt, mezzanine debt, convertible debt, and more. These titles of debt simply mean where that lies in order of getting paid back. All debt gets paid before equity. It's a safe loan for the lender, but the profit potential is low. Now, equity also comes in different forms. There is common equity or common stock, and preferred equity or preferred stock. Stock and equity basically mean the same thing. It is also called a residual claim. Why was the lender ready to take just a 10% return while the equity produced a far greater rate of return? The lender anticipated that if the business failed, they could sell the iced tea stand. The stockholder, though, is taking a risk. They risked losing their investment if the company failed. Therefore, they were entitled to a bigger return if it succeeded. How do you assess risk? Many people think about risk as the risk of stock prices fluctuating daily. That's not the risk you should worry about. If you invest in a business, the risk is losing your money permanently. Don't worry about short-term price swings when deciding where to put your money. What matters is whether or not you will get your money back and earn a return on your investment. Let's consider risk by comparing some different investments. Say you buy government bonds, which are considered the lowest risk form of investment but don't give a great return. In 2022, the 10-year Treasury bond rate went from under 2% to about 4%, an average of about a 3% return. If you give the US government $1,000, you would get $30 a year in interest, and at the end of 10 years, you get your $1,000 back. Not great, but very safe. Now your iced tea stand lender charged you 10% because they were making an investment that presented a much higher risk. Equity investors think about this in a similar way. The more risky the business they are invested in, the higher the rate of return the equity investor is going to expect. The reverse is also true. The less risky the business, the lower the rate of return they expect. Furthermore, equity investors don't get interest the same way a lender does. They get the potential to receive dividends over the life of an investment in the company. Okay, you started up this iced tea business 5 years ago. The goal was to make money. The business is performing great, but you've not seen any cash come back to you since starting it. So where is your money? Raising capital. Let's say that you need $4,000 to purchase a car. Well, the problem is that you've started this company and taken all the cash the business generates and reinvested it back into the business. You bought more and more iced tea stands. The growth is accelerating and you feel great about it, but you need some money. Well, how do you get some money out? Well, you've got a company that generates a lot of cash each year. So one alternative is perhaps you don't grow as quickly. You don't buy as many iced tea stands and you start taking that money out of the company in the form of a dividend, where each year you pay out some amount of cash from the company, but there's only about $2,000 cash in the company today. If you took that out, it is only half of what you need to buy a car. So how do you get the rest of the money, or how do you get more money? You could sell the company, that's one alternative. But the problem there is, you've got this really good business and it's growing really quickly, so you don't want to get rid of it right now. The other option, besides selling the whole business, is to sell a part of it, which you can do privately. You can sell a stake of the business to an investor if the business is valuable enough. Or you could go public. Everyone has probably heard of an IPO, which stands for Initial Public Offering. This is, for example, where a company sells a piece of itself and lists it on the stock exchange. Going public means selling shares to the broader public instead of one investor. And the best way to do it is to work with an experienced lawyer. You get a good bank, investment bank. Your underwriter will create a prospectus detailing the risks and rewards of investing in your company. The business history will be in it. It will have the balance sheet we discussed earlier, and the income statement spanning several years will be included. Investors will examine the cash flow accounts to decide if they want to invest. This is exciting for you because when you sell shares to the public, it is usually the best way to get the best price for the company. But you don't have to sell 100% of the business to the public. In fact, typically, you only sell a small percentage. You get to keep the rest. You get to keep control of the company, but you get to raise money in the offering, and you can use that money to buy the car that you wanted. Valuation, determining the value of a company. Now, before you decide to go public or even to sell it at all, it's probably a good idea to figure out what the business is worth. So what is the business worth today? Well, one way to look at it would be to look at other iced tea stand companies. Let's pick a comparable scenario. Say another iced tea stand stock trades at 20 times earnings. Okay, so apply that to your company. You received $1 per share in year 5. So multiply that dollar by 20. And this comparison values your business at $20 per share. Your company has 1,500 shares. This is known as the shares outstanding. So multiply 1,500 times 20. And your company is worth $30,000. Nice! So you had a company that began with $1,500 and is now worth $30,000 after 5 years. That is actually quite good. How do you raise that $4,000 for your car if your business value is at $30,000? Now, if you sold 200 of your shares, which are now worth $20 each, you could raise the $4,000 you need. So what does that mean? What if you sold 200 shares to the public market? Well, your interest in the business would go down because you now own a little bit less of the company. A third belongs to your private investor who invested $500 at the very start. If you sold 200 shares of the total 1,500 shares outstanding, your ownership would drop from 67% to 53%. But now, since the company is now owned by public shareholders, you need a board of directors to represent their interests and a lot of other legal stuff. The IPO makes stock liquid. Your stock would trade on the public markets. and you could sell more so new investors could acquire it. Also, each day you could look up the price on the web and find out what your business is worth. Okay, now how does this matter to you? Why did you learn all this? Now the purpose of your iced tea stand example is just to give you a primer on what companies are, what they do, how they earn profits, and what reports they provide to investors so investors can figure out what they're worth. This is meant to give you a sense of some of the things you need to think about when you're thinking about investing perhaps some of your own money in an iced tea stand or a company. So now you know what's going to happen to your business in the future. But this is just the second part of this 4-part series. In the next video, you will learn the keys to successful investing, so check out part 3 of this series. We're going to wrap things up here for today. We hope you liked this video. If you want more information on this, check out our other videos on the screen. Thank you for watching.